On the 28th of December 2021, Roubini was asked a question as it concerns hyperinflation, money velocity, and all that stuff. So we're going to see what he's had to say in that regard.
So there's a question that says, fear mongers say money printing induces hyperinflation and fall of the dollar. Others say money velocity causes inflation, seeing decrease of velocity since stimuli decreased compared to the start of pandemic. What are the tail risk in percentage of hyperinflation and deflation?
We can see what money velocity is. So according to Investopedia, it's saying here, the velocity of money is a measurement of the rate at which money is exchanged in an economy. It is the number of times that money moves from one entity to another. It also refers to how much a unit of currency is used in a given period of time. Simply put, it is the rate at which consumers and businesses and economy collectively spend money. Okay, so there's the velocity of money is typically higher in expanding economies and lower in contracting economies. So right now there is inflation going on right now. What could it possibly be? A higher velocity or lower velocity? Well, if you know what the answer is, you can put it in the comment box below. So, and then he also mentioned tail risk. That's what the question was all about, amongst other things, tail risk. So it is a chance of an event or of a rare event occurring as predicted by a probability distribution. So this is an example of a probability distribution. So the risk, anything beyond this 3 standard deviation, is regarded as tail risk. So anything beyond here, beyond this point, is usually a rare event, and of course they will definitely be more severe. But in economic terms, it can be severe. But when it comes to equity trading, for instance, then you're talking about not so bad. That'll be good for you if your portfolio has had a rare event on this side, which will put profits in your account, but this is severely negative. So in an economy, this is you don't want anything at all, rare event at all. You don't want anything beyond 3 standard deviation, all that stuff. So that's in a nutshell what this is all about. So let's return and see what it is he's saying. Okay.
Well, I would say the following thing. We had unconventional monetary policy after the global financial crisis of 2007-2009, but that did not lead to inflation. I would say, for 2 reasons. One is there was a collapse of velocity, so all the money was being hoarded as excess reserve rather than being spent or being lent out. And secondly, aggregate demand was weak because the fiscal stimulus was also very small. So we didn't have a fiscal stimulus leading to rapid economic growth, and therefore we stayed in a period initially of deflation and then of low-flation. However, the situation after the COVID crisis has been different. Inflation in the United States right now is running at the annual rate of 6.8%, around 5% for core. In Europe is around 5% for overall inflation. In Germany 6%, in Canada, in UK, in Australia, New Zealand, well above the target of 2%. What are the differences? The differences are that the scale of quantitative easing and credit easing has been much bigger than after the global financial crisis. 2, that we had much more fiscal stimulus than after the global financial crisis. The stimulus in advanced economies has been running at an annual rate of 10 to 15% of GDP, 10 in Europe, 15% of GDP in the United States, and effectively we had policies of direct monetization of these fiscal deficits. Because as we were doing QE and large budget deficit, we're financing this deficit by literally printing money rather than issuing debt. That's what people refer to as helicopter drop of money, or modern monetary theory, or permanent debt monetization.
So let's see what permanent monetization is all about. You can see here on Wikipedia. Okay, debt monetization or monetary financing is the practice of a government borrowing money from the central bank to finance public spending instead of selling bonds to private investors or raising taxes. The central banks buy debt and essentially creating new money in the process to do so. So you can see what it is. The practice is often informally and pejoratively called printing money or money creation. It is prohibited in many countries because it is considered dangerous due to the risk of creating runaway inflation. You can see you already get the idea of what direct debt monetization is essentially all about. Okay, so let's return to what he's saying.
So it's the combination of excessive monetary stimulus, excessive fiscal stimulus, excessive credit easing, together of course with the fact that during the COVID crisis we've had a number of severe supply bottlenecks that reduce aggregate supply, and we had also this process of great resignation where workers have become more influential and more powerful. They've lost some jobs and they don't want to return with jobs with low income, low wages, low benefits and so on. So the market power of workers increased.
Yes, indeed, the market power of workers have increased. Absolutely, yes. We have seen that in so many places. In your own local area, you must have observed that. You definitely heard about McDonald's increasing their prices, and in so many other places, workers can literally just, even workers that don't have any unions, they just tell their employers, look, you have to raise the wages, and they do that because there are no options. They are definitely occurring, definitely in US and the UK. This is absolutely occurring. The market power of workers has definitely increased. There isn't any doubt about that. There's most certainly no doubt about that.
So you have a supply side aspect of it. There's a global supply chain bottlenecks and the great resignation and reduction in labor force participation rate. But then on the aggregate demand side, you had essentially loose monetary and fiscal policy. And the combination of these things together, massive aggregate demand, pent-up savings, now pent-up demand that is being released, together with supply bottleneck that's led to this increase in inflation. And even central banks that for a while were saying this is temporary, only based on base effects, are now agreeing that is more persistent over time. That's why the Fed, the ECB, the BOE, the Bank of Canada, the RBA, and so on, with exception of the Bank of Japan, they're all phasing out their quantitative easing to different speed, and they're all starting to think about raising policy rates as a way of fighting inflation. If we don't do that, inflation could become endemic because you'll have a process of a wage price spiral that increases inflation expectation. And if inflation expectation rise too much, too fast, too soon, then you end up into an inflation trap. And if you're going to have also negative supply shock of the sort that I talked about today, globalization is one of them, decoupling between US and China is another one, global climate change, restriction to trade, restriction to migration, even cyber warfare, even pandemic.
We have seen for sure that this sort of things, globalization, the decoupling between US and China, reshoring manufacturing, and all that stuff to the US and other stuff. We have seen that they are already going on. The backlash against globalization. You can see a video we uploaded in that regard, because that was largely based on what he had to say in that regard. The decoupling between China and US, the global climate change and all that stuff, restriction to trade. We have seen that as well in all sorts of means that trade is being restricted, and all that stuff. Yeah.
All these things are negative supply shocks that reduce growth, increase the cost of production, and they can lead not only to inflation but also to stagflation, low if not negative growth. So I would say we have to take seriously now the risk of inflation rather than deflation. I wouldn't worry about hyperinflation. I think hyperinflation occurs in extreme situation where you have a runaway fiscal deficit that are monetized forever. It happened in Argentina, it happened in Bolivia, it happened in Zimbabwe. It happened, of course, in the period between World War I and World War II in places like the Weimar Republic of Germany or in Hungary. I don't worry about hyperinflation in the US, in Europe and advanced economies, but I do worry about the fact that inflation is going to be much higher than before, and that's going to present significant dilemmas for central banks. There'll be damn if you do and damn if you don't. If they fight inflation, they could cause a recession. If they don't fight inflation, because they care about growth and jobs, then they may unanchor inflation expectation and lead us eventually to high inflation and eventually to stagflation.
Okay, so let me give you an idea of what this on anchor inflation expectations is all about. You can see here on Seeking Alpha, it says here on anchored. This is the idea that consumer price inflation is in part a psychological phenomenon, that inflation expectations are a key factor in driving future inflation. The idea is that once consumers expect inflation in the future and accept it, what I call the inflationary mindset, they will adjust to it and pay higher prices rather than refuse to buy at those prices. You can see how these things, it's a real thing. It's a real thing. And it's a cycle that keeps on feeding on itself. Investors pay that. You, the retailer, you be said, oh yes, they are accepting it, and then you would even increase further, and then it keeps on going higher and higher and higher. You can see that this is a real thing. It is a real thing. And then so in my opinion, I would conclude that he has indicated that the tail risk of probability that I'll conclude that he has. He has indicated that the tail risk of probability or the tail risk or probability of having hyperinflation or deflation, given the current state of money velocity globally, I would say is minimal. Yeah, it's even though all of these things are happening and the prospect of things going wrong, I would also say it's really minimal. And especially yes, this this last piece of explanation here on anchoring of inflation, even though it is a real thing, you can see how it can easily affect inflation and drive it higher. But I think based on what he has said, the risk of the tail risk of having a hyperinflation or deflation, I think is still pretty much minimal as well. Okay, so thank you very much for watching this video.